We got some massive news for Alphabet stock investors as the company announced it will be borrowing $25 billion, or in other words, issuing $25 billion in bonds. This comes days after Meta Platforms issued $30 billion of bond. This is all to fund investments in capital expenditures to develop artificial intelligence, and I'll discuss what this means for Alphabet stock investors and whether or not I think Alphabet stock is a buy at current market prices.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So here's the details. Bloomberg reporting that Alphabet sold $17.5 billion of bonds in the United States after issuing $7.5 billion of notes in Europe, adding to the wave of borrowing from tech companies, of course, to fund investments in artificial intelligence. But they don't really need this money to fund investments in artificial intelligence. Meta Platforms and Alphabet, for that matter, have plenty of cash on the balance sheet, but they chose to borrow money not just because they are investing in AI, but because they can borrow money at relatively low cost and they have something to spend it on now with the discovery of artificial intelligence and the good return on investment they're seeing in these investments. They wouldn't be putting this money out there if they weren't seeing a great return on investment returned. And so the incremental sales they're seeing and the orders they're getting and the conversations they're having is encouraging them to continue spending. In fact, last week, Alphabet, Meta, Microsoft, and Amazon all reported quarterly financial results. They all reported fantastic growth in their artificial intelligence units, or the units that house their AI endeavors. And they also all announced that they will be increasing their spending significantly as a result of those good results they're seeing. And so as we move forward, we're seeing continued growth in artificial intelligence, continued orders, continued demand from customers. Money keeps coming in, productivity continues improving, and so continued funding for this category is likely to persist for several years more. Now, let me discuss the details of why a company like Alphabet that has tens of billions of dollars, almost $100 billion of cash on the balance sheet, is still going out and borrowing money. And it has to do with the relatively wonky technical financial engineering aspect. And I talk about this, I think I allocate 3 chapters in my corporate finance class that I teach at university, talking about the capital structure. And, there's really only 2 ways you can fund a business, either through debt or equity. Right? Debt would be if you're starting a business, you go to your credit card and you take a cash advance to fund your business. That's starting your business with debt. Equity would be if you had $1,000 in your bank account already and you take out that $1,000 to fund your business startup, right? That's equity. It's your own equity, but it's equity. Those are the only 2 ways you can fund a business. And Alphabet and other businesses have to decide what's the best way to fund the business. And one of the ways they determine that is by checking out the cost of equity and the cost of debt. The cost of equity you can estimate using the capital asset pricing model, which takes into consideration what you can earn on your money if you were to just invest it in super safe government bonds. Right now, you can get about 4%, 4.1% to be precise, in a 10-year government bond. But then you add to that the fact that when you're investing in a stock or when you're investing in a business, it's riskier than investing in a government bond. So you add what I call, and what many financial participants call, the market risk premium. In my model for valuing companies, the market risk premium I use is 6%. Now, historically, analysts have used somewhere in the range of 4% to 6% as their market risk premium, and I've used 4% to 6% as well, changing that market risk premium based on my perception of what I see as risk in investing in equities. When I feel the risk is lower, I will lower the market risk premium closer to 4%. When I see the risk is higher, which I see right now, I will increase the risk to 6%. Okay. And then you incorporate the company's specific factors. Not only are you taking risk when you're investing in any business, but then you're taking specific risk based on the specific business that you're investing in. Some businesses are more risky than others. Some of the factors that change the riskiness of the business is if the business is cyclical. For instance, a car company is a cyclical business. When the economy is doing well, people buy more cars because they get jobs, and when they get jobs, they want reliable transportation, so they'll buy a car. When the economy does poorly, the opposite happens. And so that makes the business more risky. It's more difficult to manage a business with that kind of cyclical nature. Okay, so that company would have a higher risk profile. In Alphabet's case, its risk as measured with the beta is on par with the average stock in the S&P 500. So you're not taking any additional risk. So using the capital asset pricing model to determine the cost of Alphabet's equity gives us a cost of 10%. Whereas I estimate that Alphabet can borrow money at an after-tax cost of debt of around 6%. And it might be even lower than that because you can deduct the interest expense from your income and thereby get a tax benefit for your interest expense. You can't get a tax benefit for your cost of equity because paying dividends is not tax deductible, at least not in the United States. And so the cost of debt is 6%, the cost of equity is 10% for Alphabet. That's why it chose to borrow $25 billion. The more money it borrows, the more of its capital structure is funded with debt, and the lower the weighted average cost of capital will be, which is the denominator that most financial analysts and most investors use to discount the cash flows expected in future years. So this is a financial engineering reason why Alphabet is borrowing $25 billion and why Meta Platforms, I released a similar video about Meta Platforms that I published today, talking about the similar reasons why Meta Platforms chose to borrow $30 billion, right? It's to shift the capital structure, weight it more towards debt and less towards equity, and thereby reduce the weighted average cost of capital. So still, if we incorporate before this announcement, Alphabet had roughly $24 billion of debt. After this announcement, after this gets reflected in its balance sheet, it will have roughly double this amount, or about $50 billion in debt, which would still be a relatively low debt to equity ratio considering a market capitalization of 3.4 trillion and debt of only $50 billion. It's still a relatively safe bet for lenders to give Alphabet money, and the cost of debt is still lower. Now you might be asking, as many of my students ask when I'm giving this lecture in class, why don't companies just fund all of their business with debt and just have zero equity, and they can lower their weighted average cost of capital from 9.5% to 6%? Why don't all businesses do that all the time? So I think many of you are smart enough to answer that question yourself as you are asking it, and it goes to point the riskiness of a business. If a business has only $50 billion in debt versus $3.5 trillion in market cap, that's not very risky for the lender because the lender can feel comfortable that this company can issue shares if it needs to raise cash to pay down debt. Similar for your personal finance, if you're making $10,000 a month and you only have $1,000 of expenses every month, then a lender will be happy to give you a mortgage or give you a car loan because you have plenty more income than you do expense. But if you start to borrow more and more money and your expense or your debt starts to surpass your savings and your income, then you become a lot riskier and the lender will not be interested in lending you money. So this is why CFOs get paid the big bucks, is to calculate and measure precisely where is the optimum weighted average cost of capital. Where is the optimum mix of debt and equity to provide the lowest weighted average cost of capital? That's why CFOs get so much money. That's one of their main jobs to do, is to minimize that weighted average cost of capital. And they balance that factor using several tools at their disposal in order to make sure they balance that. Don't increase the debt too much where it becomes risky for lenders and increases their cost of debt to a point where it doesn't make sense to borrow more, but also make sure to capitalize on enough debt to make sure your weighted average cost of capital is low enough to provide a good valuation to shareholders. So I do see this as a good thing for Alphabet to be incurring debt. And I've had Alphabet rated as one of the best stocks to buy this year. And I still think that's the case. I think this is a great investment for long-term buyers, and I own the stock myself. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.